Welcome to your commercial-free, uninterrupted investment show, sponsored by the SEC-registered investment firm, Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who has been putting clients' investment needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. With me is Chase Wilsey. Good morning, Chase. How you doing?
Hey, good morning. Doing well.
Oh, good. We got a lot to talk about. It's kind of funny. Before the show, we talk about different things, talking about Roku, talking about Bed Bath & Beyond and different things. Almost like, gosh, it'd be kind of cool to let listeners hear what we talk about prior to the show, but we'll just do it during the show, I guess is what we'll do. But let's start off talking about Apple products, because in the past we have posted about where will Apple find the next area of growth for their business. One area of growth for them could be the $452 billion mobile ad market, which could grow to $680 billion in 2026.
And they also may take advantage of trying to get into the online advertising market, which is about $600 billion. And there are many different ways that Apple may end up putting advertising on your phone and through your apps that you have. It's going to be interesting to see how they handle this over the next few years and how consumers accept more advertising on their phone. And especially with a company like Apple, I know a lot of times people appreciate Apple for like the privacy, and you know they had some big problems with, well, not they, but Facebook had the big problems with Apple because of the way they changed their privacy laws. So is it going to be a little bit hypocritical, let's say, to say, oh, no, Facebook, yeah, you got to be careful, but no, we're Apple. We don't have to do that. That's something I want to keep an eye on.
And one thing that kind of irritates me a little bit is like I'm paying Verizon for the use of the phone. I paid Apple for the phone. Now you're going to clog my phone up with advertisements? I don't think that's right, because I'm already paying two people for the service. Why do I have to go around and I don't know how they were going to do it. I mean, we're just talking about things that they could do, because we have talked about them running out of products or to get that growth. This is one thing that they're considering. I don't see how it would be a positive thing.
Yeah, I don't either. I especially when I have my phone. I feel like that's my area.
My phone.
Yeah, and if I'm browsing the web, I don't have an issue with ads. But can you imagine that? I'm not saying they're going to do this. You unlock your phone, ad.
Yeah.
Like, what? Oh, you can pay $5 a month so you don't have to have ads on your phone. You're like, oh, this sucks. But, I mean, I don't know what direction they're taking. As you said, these are just very, very speculative ideas that we have here. It's just another potential area of growth Apple can look at. And people know we don't like Apple stock.
Right.
It's a great company. I mean, they have done a great job in the phone market. It's so funny now, too. I hate when people don't have Apple phones, because they have the group messages, and you can, like, add people to group messages. But if somebody else doesn't have an Apple phone, it's a pain in the butt.
They're out of the group.
Like, who made the group green? You know? So, I mean, Apple is a great company. It's just, it's as we always say, it's too expensive. And we talk about areas for potential growth. This is why companies that trade at high multiples always concern me, because you start to reach for growth. And if you start to reach for growth in, let's say, the advertising market, it could hurt your base. And all of a sudden they say, I don't really want the Apple phone anymore. And then you actually start to lose growth in areas that are important to your business.
And one thing, again, we do like Apple, the company, just think the stock is too expensive. But one thing I'm thinking about, we saw this with General Motors this past week, where they're going to do a big buyback before they get hit with a 1% tax January 1 of 2023. I don't know, and I'm hoping somebody calls in about Apple, because I thought their debt was rising quite a bit, but they still have a lot of cash on the balance sheet. So I'm wondering, will they announce, okay, between now and December, we'll buy back, I don't know, $20 billion of stock, could boost the stock, which would not be a good, well, a buyback will reduce the number of shareholders, so to help the earnings per share. But still, I think it'll be an artificial thing. Still not fixing the problem of the high price of the stock.
Well, it concerns me with these companies doing these big buybacks now, and especially ones that trade at lofty valuations, because if you're trading at a lower valuation, you can buy back more stock and increase the EPS at a higher rate. EPS and earnings per share. But if you're trading again at around 30 times earnings, you buy back a bunch of stock, you're not buying back as much stock. And it might be a higher dollar amount, but on a percentage basis, it's not helping earnings per share as much as a company that's, say, trading at around 10, 12 times earnings. But then the issue becomes, okay, you front load it, you've created all this demand for your stock. Because again, they're going and buying the stock, so that's going to push the stock price higher, all else equal. What happens next year when you used all your buybacks this year? Who's going to be buying the stock?
Yeah.
There's going to be less demand out there for the stock. You could see some issues for stock prices then. So it's something that I do worry about, is that artificial bump you may see in some companies as we finish out 2022.
It's kind of like what happened with Bed Bath & Beyond, which we'll get to in a minute. But the other thing, too, on Apple that worries me is I believe they started taking on debt 5 to 7 years ago. So I'm curious when that debt starts coming due. Because that's another thing. Should they be buying back stock or paying down debt? And again, if you're an owner of this company, you need to have the answers to these questions. We're just asking these questions. We don't own Apple in the portfolio. But if I owned it, we would be looking at, well, when does this debt come due? What are they doing here? So you really need to do a deep dive into it, I think. Great company, but you don't want a company that for the next 5 to 10 years goes from, we'll say, 140 to 180, back and forth, never goes beyond that.
Yeah, then just last thought I kind of have on Apple, too, is, I was listening to a gentleman on Fox Business the other day talking about how there's the Apple 14, I think is what we're on now, is coming out, and it's going to be super exciting, and there's a big potential cycle for it because now several iPhones are 2 to 3 years old. But I've talked about this before.
How old is your phone?
I still got the iPhone 8, and I'll hold it until it crashes and burns. Right. But the thing is, I still don't see that big of a difference between, let's say, like the X or the 11 and the 14. I haven't seen anything too big of an advancement. So there's people out there looking for a big growth cycle, and I've talked about this as well, is all of a sudden you're looking for that growth cycle, and that growth cycle doesn't happen. Let's say sales on the iPhone are relatively flat. That's when, again, the stock could have problems. So I believe that's next month, actually, is that they have the release of the 14.
Yeah, it's only a few weeks away because this is we'll call it late August here. And I think it's mid-September that comes out. So I think it's less than a month. And I do remember, I forget which one it was, but there was, over the time of Apple, there's been times they come out with we got the new cycle, and it was a failure. And I think the stock dropped 30, maybe 40% because it wasn't what they expected. And people, I think now, they are kind of pulling back a little bit. Like, you know what? My iPhone, I'm not going to say 8, my iPhone, is there 11 or 12?
X11,
yeah, that's fine. I don't need a new one. And again, I don't even know what I have. But it's just, there's nothing major that, wow, this can take a better picture. I can wait.
People can send me the pictures on my phone. This is actually better for me, so I don't have to take the photos.
Yeah. And it's a great product, but I just don't see how they're going to improve upon it that much. And when people think about, I'll save a few bucks here and wait till maybe next year to get the phone. So we'll see on that. So again, you always want to be careful of these high flying stocks, as we call them, because they're growth companies and they move the wrong direction. Because of something, you could be hurt there. Let's talk about home buying, because the affordable index of homes in the U.S. has fallen to 98.3, which is the worst since June 1989. With rising mortgage rates and the sale price of homes not dropping yet, home buyers just cannot afford to buy a home. If you're already in a home, you do have the appreciation to use your down payment on a new home. But if you're trying to get into your first dream home, that is getting further and further away for the first-time home buyers.
And not only are the payments harder to qualify for, but the 20% down payment on a home is also much harder to achieve. If you look at a $400,000 home, the 20% down payment would only be $80,000 versus a home of $600,000 that would require a down payment of $120,000. That's a 50% increase. That's a lot of money. That's $40,000. That's, after tax, a lot. Some people's, take-home pay, essentially.
Yeah.
The other thing, too, is preventing homeowners from moving up to another level if they cannot sell their existing home to first-time home buyers.
And one thing, we use the nationwide average of $400,000. People saying, well, who can afford a house, $400,000 house in San Diego? We do things nationwide. We look at a lot of things. So if you take those numbers and you put it to $600,000 or even $800,000, it will increase dramatically on what that is.
$800,000 and $1 million is what you need here in San Diego.
Yeah. So, and Frank just passed me a message that the iPhone 14 comes out September 7th. So, yeah, that's about 3 weeks away.
Yeah, a few weeks away there.
Thanks for doing that, Frank.
Yeah, and I was going to say, too, the other interesting thing about the homes is we looked at some of the existing home sales that came out, and those have really started to struggle as well. That they're actually at the lowest level, if you exclude COVID, because that was such a weird time period, since November 2015. So the demand side is starting to slow down, but the problem is supply still remains extremely constrained.
Right.
And if you look at it, there's just 1.31 million homes on the market, existing homes, at the end of July. That was 3.3 months worth of supply.
Right.
Generally, a healthy market's about 5 to 6 months. And the other crazy thing, too, is you look at the first-time home buyer, they only made up 29% of the market.
Right.
Generally, it's around 40%.
Yeah.
So the affordability is a big issue. And you can't just have these home prices keep going up, and mortgage rates, I don't think, are going to go back down substantially. So one of those has to give to allow that affordability to rise, to, again, allow people to get into the market and buy homes.
I had a good conversation on social media with our good friend Robert Behek about home prices, because he is right. He's saying that for this year, home prices will be up. And I said, yeah, for the entire year they will be. But I said, what about 2023 is what's kind of worrying me, because I think we will have positive numbers for the entire year of 2022. I don't think there's much growth from here to the end of the year, but, just based on what we're talking about here. But when you look back at 2022, it'll be a positive year. I'm not going to throw out a number, but it will be positive.
High single digits, low double digits, I think, if you look at the full year.
Yeah, full year. Yeah. So things are definitely changing. You're seeing the signs on the wall. And I think it was Fitch, who does ratings and so forth. Yeah. They're seeing real estate, again, we're talking nationwide, drop 15%.
Well, and the other interesting thing, too, is the cancellations you're starting to see on these homes.
Yeah.
I mean, those have raised substantially. I mean, if you look at, like, home builders, that is crazy. Right now, 17.6% of builder contracts fell through in the month of July. That compares to about 8% in April and 7.5% in July. So you've more than doubled the amount of cancellations on that. And then also, to the existing homes, you're at about 16% of homes that went under contract have actually seen cancellations. That compares to about 12.5% in July 2021. So the high interest rates, the high home prices, they are having a major impact on the real estate market. And again, something's got to give to allow for people to buy homes.
It's kind of funny because I've begun my home search. I'm not going to buy tomorrow. But when you look at a chart on a stock, and it's like this, like a slope right up to the top of the mountain.
And our viewers can't see your hands.
Right,
but
my hands are going up, like dramatically up. Well, that's what it is when you look at a house. You look at a house and before the house was $2 million, now 2 years later it's $4 million. It's like, that's a huge increase. You don't want to buy at the top, whether it's a house or a stock or anything. So you've got to have some type of pullback for all these reasons we're talking about. Affordability, rising interest rates, and rates are not going to go down tomorrow. Maybe they may go down tomorrow, but a year from now they're not going to be lower. Yeah. We know the Fed has to reverse on inflation, raise interest rates, so that's going to be a difficult time for the market going forward.
Absolutely.
All right, well, I do want to talk about Generation Z, because these are people who are ages 18 and 24, have been active generational investors, with half of them investing and 26% buying stocks. They have really only experienced a decline from COVID and feel stocks always rebound quickly. This year, they are learning a new lesson, and a Bankrate survey found that 73% of Gen Z traded actively this year, compared with Gen Xers, who are 42 to 57, just 28% traded.
And with baby boomers, they only saw 25% of them trade. I think the problem could be is where Gen Z is getting their information. Half of them learn investing on YouTube and by watching other exciting videos, and 1/3 receive their education on TikTok. Now, I don't believe Warren Buffett's on TikTok.
No, I don't think he is. No.
And in my opinion, those are probably not the best sources. At their age and their experience level, they expect quick rewards as opposed to having long-term patience, and it's a concern.
Yeah.
And I mean, we'll talk about Bed Bath & Beyond, but, I mean, there's an interview I want to talk about yesterday with David Portnoy and Stuart Varney on Fox Business as well, that this is the exact issue we're talking about. And we'll talk about Bed Bath & Beyond first. I mean, this company that, quite frankly, is a terrible company.
Yeah.
Has skyrocketed for nothing other than meme hype.
Yeah, I mean, they have no earnings. They have no equity. They have they don't pay a dividend any longer. Their sales were down 25% year over year, and industry was up 61%. I mean, and I think you even mentioned that they don't have enough money to buy their holiday inventory.
Yeah, that's what Fox Business had mentioned. And it's like, wow, that's a company I want to buy. And I think at one point they're up like 600, 500, 600% on the month at the peak.
Right.
But again, it's these people that they get into the hype frenzy, and if you had bought that stock, I believe Wednesday morning, you're down 60% as of the close yesterday, or about 60% as of the close. It was down around 40% yesterday alone.
Right. And
the reason for that is not because of business fundamentals, but because their guy, Ryan Cohen, sold out of the company.
and it's just like, he made a smart move. And if you're sitting there watching that stock move up, from 11, 12 to 30, 34, you're kind of foolish thinking, well, and this happens in investing. Yeah. Well, it went to 30. It's probably next stop is going to be 60. Mm-hmm. And he's saying, no, I think he made a $60 million profit. No, I've done good. I think I'm going to sell it. Because this is what true gambling is. This is not investing at all. This is gambling on a stock price. And he threw the dice, and he took them off the table. But small investors, they got greedy.
Yeah, and I think he said he made like $30 or $60 million off the...
$60 million.
Yeah, 60. Yeah. And people, that's not fair. I'm sorry. This is really rude, but you're the idiots that gave him the money. Yeah. And it was funny. People on the messaging board were saying, oh, well, he's an ape. He's like one of us. No way he's sold. I'm sorry. He's a businessman. I think he looked at it and said, oh, I'm going to make money off of this. Yeah, I'm out. And he doesn't care about this whole movement. And if he does, he took advantage of the movement. And I really don't feel bad for these people that had these substantial declines. If you bought at the top on Bed Bath & Beyond and you're down that level, what were you thinking?
As I said, you think it went to 30. You think it's going to go to 60. And he had no advantage over anybody else. No. He just pulled the trigger. Now, because he had so much of it, when he pulled the trigger and sold it, it really hurt the stock. Where a small investor, that wouldn't happen. But still, he did not have any advantage over anybody else. He just said, no, I've got a great profit. I'm selling out, which everybody else in that stock had the same thing. And you and I just talked about how the fundamentals of this company, it's not even there. If this makes it to January 1, I think I'd be surprised. So you're just gambling on this chip. And the whole thing that they're doing, and I heard somebody also talking on TV that, well, this is a good lesson for them. The problem is, they learned a lesson that stocks are not good because they didn't know what they were doing. Not that there is a true way to invest, and you should be happy earning an 8, 10, maybe a 12% on average return every year versus doubling your money in a week. That's not a good lesson. You got to learn that to really make money, if you're earning 10% on average per year over a 10-year period, wow, that's a pretty good return. I could live with that.
Yeah, and that's the unfortunate case. And I mean, I was talking about David Portnoy, who is the founder of Barstool Sports, and I think he created a great company there. I mean, I find their videos quite funny. I think they do a good job, but he's not a stock expert, a financial expert, and he was talking on the show yesterday about how all stocks are like gambling. And Varney pushed back quite hard on that and said no. And it's like, well, they're doing their research too by going to the Reddit forums. That's not research.
No.
I mean, that has nothing to do with what a stock is. A stock, again, is ownership in a company. And we talked about it yesterday too. He's right. Over the next week, month, yes, all stocks, I don't care what you're doing, they're gambling chips in that time frame.
Yep.
But you expand it out over 4, 5, 6, 7 years, they're not gambling chips. If you own the right companies, the strong businesses will flourish. And that's what Benjamin Graham says. In short term, it's a voting machine. It's just going up and down all over the place. Long term, it's a weighing machine. Those strong companies will outperform the weak ones over 5-year periods. But the funny thing is, over the next month, the weakest company could outperform the strongest company.
Yeah. And, you were wrong and so forth. Well, I'd rather be wrong on the short term and right on the long term all day long.
Yeah.
And whenever we invest in a company, I mean, we're investing generally for 3 to 5 years. And, even when people come in and say, well, how does Wilson Asset Management manage money? We even show them, we might buy a stock here and it goes down. But we don't worry about that because where will it be, again, 3, 4, 5 years down the road? Like, oh, it's up 100%. Oh, glad we did that one.
Yeah.
But you might buy it at 10. It could go to 8 next week. Like, oh, you're down 20%. Well, that's just the gambling part. We don't care about that. We want to own businesses that have great balance sheets, good earnings, good cash flow. And this is what you should do as your true investor. And this whole Reddit thing is just a gambling game that's being played. And it's fun, but it can really hurt you on the downside.
And I think the problem is investors, and I'm not going to call them investors, traders took away the positive side of what happened during the meme stocks with GameStop and AMC and thought, oh, I can get in and get out. Yeah. But I think they forgot about the bad part where it crashed 70%, 80% after the fact. And now that's what you're witnessing with Bed Bath & Beyond. And the people that get burned here, as I said, I mean, it's the small guy that gets stuck holding the bag, but you just did not educate yourself. I mean, one thing that you got to do in life is you have to learn from your mistakes and learn from the mistakes of others. And clearly, with Bed Bath & Beyond, nobody learned from the AMC and GameStop hype.
Yeah. And there'll be others, unfortunately. And I kind of thought that it was gone, the meme stocks. You didn't hear about it for a while, and then it came back again with Bed Bath & Beyond. But again, and the thing, too, I think the more it's around, the more people get burned, the less that will come back. So eventually it will just be gone. And
they were talking the other day as well about the economy and how there's still a lot of money in the economy, and we've talked about that as well. I think that's still why people can gamble a little bit here.
Yeah.
And say, I still got extra cash.
Yeah.
That's what we're going to start bumping up against, is as the Fed again starts to reduce that balance sheet, they start to suck that money out of the supply. That's where I think you're going to really start to see these hype stocks, again, have big issues.
Yep. Let me go to the phone numbers. I got so involved in the conversation, I didn't give out the phone numbers for that unbiased, no strings attached, fundamental opinion about what you want to talk about. 833-288-0973. That's 833-288-0973. Give us a call. You got a company that you're looking at buying, investing in. We mentioned some different companies. Maybe you hold them. You're not sure. You want more detail on them. That's what we're doing here. So I do see it, and I don't know.
And I know one thing, too, that we want to mention is when we look at the different talking points that we went over today, we do have our Smart Investing newsletter as well. If you kind of found those conversations interesting, wanted to make sure we let our listeners know about the other topics that we did have.
Yeah, I'm glad you brought that up because if you want more detail, what we talked about, those three items, you can see that. You can also see we did talk about the Reduction Act in the newsletter, China, inventory and sales, more on housing, the emerging market. Also, too, I think we did talk about savings rate due to COVID. So many different topics in there. As Chase said, it is a free newsletter. All you need to do is go to our website, smartinvesting2000.com. Again, that's smartinvesting2000.com. You'll see it right in the middle of the page on the top. It says newsletter right next to the podcast button there. So you'll see it on our website. A lot of great information there you can take a look at. So well, let's go to the phone numbers again, 833-288-0973. Let's go out to San Diego and speak with Jeff. Jeff, you're on the Smart Investor with Brent Chase. How can we help you out?
Yeah, I'd like to get your opinion on RSG. I own it, and I don't know whether to sell it or hang on to it longer. I've done quite well on it. So
okay, so you're up on it now. How long have you held it there, Jeff?
Since June of 2020.
Okay, so if it's out of a tax, or if it's in a taxable account, you've got long-term gains. So let's take a look at it. And this isn't an area that I've always wanted to get into. I just could not find the right price. The company, again, is Republic Services, symbol is RSG. They're in the waste management industry. And that's an industry that it's growing. I mean, we get more and more trash that comes there. Not much float on this company, 0.7%, 95.3% institutional owned. We do see a PE ratio of 33.6 versus 40.1. That's my problem. They've always been expensive, never getting that buying opportunity. Price of sales are high for the company, 3.8 versus 2.0. Price to book value, 5 versus 3.7. Price of cash flow, also expensive, 16.2 versus 14.8. They do have a good PEG ratio, and your PEG ratio is your price earnings divided by growth, 2.9 versus 10. So it means you're not paying much for the future growth of this company. But these numbers here, the earnings growth over the last year, 24.2%, industry up 38.5. We do see sales are up 16.3, industry up 19.3. The 5-year growth estimate from the analyst is 10.6 versus 6 for the industry. They do pay, I'll call it a decent dividend, 1.4%. Use about 42% of the earnings to pay that out. Look at the balance sheet. Current ratio 0.7 versus 1.2. That's on my absolute bottom. That starts to concern me. It gets that low on liquidity. With a debt to equity of 1.3, same as the industry, I would like to see a little more liquidity for the company on the balance sheet. They do have a nice net profit margin though, 11.3 versus 4.9. Return on equity 15.1. versus 16.6. Jace, what do you got for the company going forward?
Yeah, so it is interesting. They are the second largest integrated provider of traditional solid waste services in the U.S. I'm guessing waste management is
the first
probably
one.
the first one. Yeah. They operate roughly 186 active landfills and more than 200 transfer stations. So they're quite large. I wonder where they operate, though, because I know my trash cans are waste management. I wonder.
I think I've seen them around here, but they don't have a big presence here in San Diego, I don't think.
The other thing that I find interesting with this company is they have high goodwill, about just 50.2% on the balance sheet. I was wondering, did they just buy another landfill? Like what?
Probably buy more landfills, probably, and you're overpaying for them, probably.
Yeah, but I guess I wonder too though if you depreciate, because if you depreciate land, that's going to reduce the equity on the company essentially, because you're depreciating that asset. So it may still be a higher price over book value, but it could be a very good generating asset in terms of cash flow.
And one thing that worries me on these too is that landfill. Well, eventually that land will be filled. Where are they going to go? I've heard of shipping across to islands and stuff. So I mean, it is a problem that we have, but the supply is never going to stop. We're not going to have trash and garbage. So that's why it's a great industry, but I still want to get a good price for it. But I digress, so go ahead.
Yeah. So current price here for RSG, well, it's $146.44, near its 52-week high of $148.26, and the 52-week low, $113.57. And trash is doing well this year. Year-to-date, up 5.7% for the company, while the index is still down about 10.6%. A good-sized business, though, $46 billion company in terms of its market cap. If I got to December 2023, I do see estimated earnings per share here of $5.35. That would give us a target sell price of $88.81. So it's expensive. And the thing that I find interesting is, again, the growth rate on this company.
Yeah.
I mean, the earnings this year estimated to grow 14%, next year about 12%. So it's still growing very, very nicely. It's just... it's expensive.
Yeah, and Jeff, and that's why you probably feel the need, like, should I sell this? I've got to say, you got to sell this company. Again, we talk about the growth going forward. We're not going to stop having trash and garbage and so forth, but it's so expensive. And, we have a discipline, and we stick to that discipline. That's how we've done well over so many years. You may sell the stock at 146. A month from now, it could be at 150, 154. But what you want to do is sell this company and try to find another company that's trading at, 10, 12 times earnings. This is probably trading at, 20, 21 times earnings.
Yeah.
Okay.
Let's see. 27 times future earnings. 27.
Wow. That's pretty high.
Yeah.
So, and again, I love the industry. I love the concept. I just don't like to overpay for anything and even hold things at overpriced, because it does come back eventually to burn you. So, all righty?
Okay, thanks for the information.
Okay, Jeff, thanks for calling. Have a good one.
Okay, bye.
Bye-bye. All right. That is over the phone line, 833-288-0973. That's 833-288-0973. Let's head out to San Diego and speak with Fred. Fred, you're on the Smart Investor over Brent Chase. How can we help you?
Yes. Good morning, gentlemen. Thank you for taking my call.
Sure. Thanks for being there.
Yeah. Hey, I got a question for you. I'll be honest with you. If I hadn't had a financial advisement firm based near Philadelphia where I grew up, I definitely go with you guys. Who knows? Maybe if I hit the lottery, I will.
We'll be here.
Or if they retire or something,
really,
hey, we're here.
No, hey, really appreciate what you do. I've been listening to you for several years now. That being said, I'm in escrow on my little condominium down in Carmel Valley, which I purchased 2 years ago. I accepted a job up in LA County, so I'm moving up there, and I plan to rent for a year to 2 years. I'm going to net out of the sale of this condominium about $150,000, and I'm probably going to buy in 1 to 2 years, depending on where I'm going to be in 1 to 2 years. I'm not really sure yet. When I spoke with my financial advisor, I said I was thinking I want to take at least half of this money, which I'm going to apply for the next purchase of my home, and maybe use it for a short-term investment in either CDs, short-term bonds, or gold. She steered me away from gold. She steered me in the direction of bonds and or CDs. Wanted to get your thoughts on it.
I mean, one thing, and you said half the money, and you're moving to L.A. I don't know. Isn't the price of housing in L.A. pretty expensive?
Yeah, believe it or not, the price of housing where I'm going to be able to live is actually a little bit lower.
Wow.
Just a little bit lower, believe it or not, in the areas where I'm looking, which is like Studio City, Tarzana, a couple other areas that are like, Hawthorne, Inglewood.
Okay. All right. Well, I mean, with that said, what I'd recommend is that, that there's a lot of online banks like Synchrony Financial, who I put my liquid money with them. I think I'm getting like 1.6%. The nice thing about that, I think, over CDs is that I believe rates will continue to rise. So right now, I said I'm getting about 1.6%. The next year, you maybe get 1.8. Maybe it might rise to 2%. The thing is that it's always liquid for you, because you'd hate to have it in a CD and you do it once a year, and then you get this great opportunity in 18 months from now, like, oh, shoot, now I got to pay a penalty to get out of that. I don't see rates declining, so I think you're safe putting it in the Synchrony Financials of the world. They are federally insured to, $250,000. That'd be my recommendation.
Yeah, and you said 1 to 2 years there, Fred?
Yes, I did.
Okay, yeah. Because that's where it's tough. I was actually talking to a gentleman the other day, and he said, I'm going to need the money in 2 years. And right now I look at the 2-year treasury, and you're getting, what, 2 point, I think it's like 2 point, yeah, actually it's in the threes, I believe.
Is it?
Yeah, because it was the yield curve was still inverted, so right. it might be around 3%. So if you were at 2 years for sure, I would say do a 2-year treasury, because it's a higher interest rate than the 1.6% you get on the bank. But then the problem is you have the interest rate risk. So if you did pull it out in a year, like, it's not worth the risk. But that's kind of one thing. The other thing that we look at that we've used in the past is it's called the floating rate fund, where that gets you a little bit higher income, but that's going to also be quite similar to like a high yield savings account. So unfortunately, there's not many great options for short-term money right now, but hey, on $75,000, you can pick up a couple. You don't want to just put it in one of the big banks and they pay you 0.01%.
Right. And the senior floating rate fund, I mean, that principal can move a little bit on you, so you want to be careful of that.
Yeah.
And Chase is right too. If you get a 3% on a 2-year treasury and you get that great buy, at 18 months from now, you sell out, rates went up to 3.5 or 4, you can make no interest at all on it. So you really got to decide what direction you want to go, and that's why I came up with Synchrony Financial for liquid money all the time, because I believe you said 1 to 2 years. You just don't want to be locked into something, and then you pay a penalty for it.
Yeah, thanks. I didn't catch the name of that company or fund. You said something financial?
Synchrony Financial.
Synchrony. Okay, very good.
Yeah.
Okay.
Yeah, they're the company that when you go to Jerome's Furniture, these buy refrigerator, also have Care and all these other things. They're the finance company behind the scenes, and then they loan up money about 12-14%, and then they pay you about 1.6%, but it's still a good deal for you.
And it's still FDIC insured.
Yeah. So, but I think that might fit you best on what you're looking for there. All righty?
Okay. Very good. Thanks so much, gentlemen. Appreciate it.
Okay, Fred, thanks for the call. Have a good one.
Thanks.
Bye-bye.
You too.
All right, that opens the phone line, 833-288-0973. Again, that's 833-288-0973. Time to talk financial planning. With that, we'll turn to our financial planner, our CFP, Harrison Johnson. Good morning, Harrison. How are you doing this morning?
Good morning. I'm doing well. How are you guys doing?
Well, good. I saw a segment on KSI this past week where they showed that there's more U-Hauls leaving the state than coming back. People have a problem. And you're talking about moving out of state in retirement. So what do you got here today?
So it seems like most of the people I talk to are considering this. They're getting ready to retire. Should they leave California for a bunch of different reasons? But two things I wanted to talk about would be the tax side of it and the real estate side of it. So first, on the tax side, California, we have the highest marginal tax rate in the nation at 13.3%, but most people fall into the 9.3% tax bracket while they're working, which is pretty high. That 9.3% bracket is very large. It goes all the way from taxable income of $120,000 all the way up to $625,000. So it's a really large bracket, and a lot of people find themselves in it while they're working, because while you're working, your primary income source is going to be wages or self-employment income, which is fully taxable at ordinary income rates. But once you shift into retirement, you might have Social Security income of $50 to $60 grand a year between you and a spouse, and all of that income is going to be tax-free in California and most other states as well. So although it's income or cash flow to you, it doesn't take up any room in the tax bracket. So in retirement, it's much more likely that you can get yourself into a much lower bracket. Same thing for like Roth accounts or non-retirement accounts. You can, withdraw income from these types of things, but it's not going to take up any room in the bracket. So for many people, the tax situation in California isn't as bad as you might think it will be. And in many cases, if you move to other states, you could actually end up paying more in state taxes because of the way other states' tax system works. The second point is real estate. So real estate is an area that does make a difference. Property values are much higher in California versus pretty much everywhere else in the country. So the question that a lot of people have is, should I sell my house that's in California, or should I rent that house that's in California after I would move? And so I'll say that I'm not anti-real estate in any capacity. I work with a lot of real estate investors, so I do like real estate if it's done correctly. But from a rental property perspective, especially in Southern California, it's more of an equity play as opposed to a cash flow play. And what I mean by that is, if you're going to invest in rental property in California, especially Southern California, your hope is that that property value is going to go up, and in the meantime, you would use the rent to pay down the mortgage. So your equity is growing as the property goes up, and you pay that mortgage balance down. It's usually not much of a cash flow play. In many cases, you might get a little bit of positive cash flow, but it's usually not going to be that much, especially if you have a mortgage. And when you go into retirement, usually the concern is cash flow, because you need cash flow to replace your wages. So in many cases, it makes more sense to sell a property that's in San Diego or in California after moving, and then you can use those proceeds to create new income streams or buy a new place, as opposed to keeping that equity locked up in that property that you have.
And Harrison, the other thing I think about too is that in California, they really make it very difficult on landlords. Chase, you told me a story this past week where somebody wasn't paying this landlord the rent. He went to the house to, I guess, collect the rent. The renter called the cops on. They came and arrested the landlord.
Or escorted him.
Yeah.
He didn't get arrested.
But he didn't get his rent. And he's the one not getting his rent, and he's the one that the police come and like, sorry, you got to leave.
Yeah, because of the squatting rights. And it's, especially if you move out of the state.
Right.
I would not keep real estate here. If it's down the street from you, maybe. But
but again, if you want the guy's property, you're gonna get arrested.
That's what I'm saying. I'm like, if you move out of California, I would say absolutely not. Don't have a rental here. Right. And I wouldn't do one if I lived. I do live here, and I wouldn't do one here.
Yeah.
I personally thought about doing ones in Arizona and other states, but just doing one in California, it's just, you could get totally screwed.
Yeah.
And I don't want that.
And Harrison, you're right, too. I don't know what state somebody would move to, but, if they love real estate, they maybe sell the property here in California and buy it in Arizona. If they're going to Arizona, so I mean, if you love rentals, do it that way, because then you're at least close to it. I would, although I do know we have clients that have real estate in Texas and North Dakota, I think, and all over the country. I just, with the real estate, I want to be close to it so I can go by and see it, make sure, things are going well with it.
Yeah, if you have a good property manager, I think it makes it.
They cost money. That hurts your return.
Yeah, but if you still look at the cash flow and it's still good.
Yeah. Well, that's one more expense that you have to deal with.
Hey,
Harrison, whose side you on here?
We always
Harrison,
talk net
side?
returns. Go ahead, Harrison.
So, yeah, back to the point. I'm usually in favor of selling. I'm usually in favor of selling it if it's in California, because in addition to all the problems you guys just mentioned, problems with dealing with tenants and extra costs and things like that. That stuff does add up. And again, real estate can be a great investment. I think there's other places where it's better, but usually when people are looking at leaving California, it's mainly driven because of financial reason. And I think in most cases it makes sense to then sell that property. Then you have all of those proceeds and you can use them to invest in other properties or buy a house for yourself or just invest it and, create income from it. So that's, there's a lot of reasons for it, but yeah, I think in most cases it makes sense to sell.
And Harrison, I assume in the state of California, if that rental is profitable, since that money was earned in California, you have to pay California state tax. Would that be correct?
If you do have positive income, it is still taxable in California, correct. Now,
Wow.
Usually because of the depreciation that you can claim in addition to property taxes, insurance, management fees, all those things, usually you can do it in a way that it won't generate any taxable profit. But yes, you are correct. If there is profit, it is taxable in the state regardless of where you end up moving to.
But if you have high income and you leave California because of the high income tax amount you have, you may not be able to enjoy that depreciation because your income's too high. So, I mean, there's just so many factors.
Well,
Yeah.
Yeah. I mean, it depends because if you move to another state like Arizona, for example, and then you have distributions from IRAs, well, that income would be taxable in Arizona, not California. Just the only reason that property income would be taxable in California because that's where the property is located. But you're right, it does get complicated, and back to the point, I think there are other places where rental properties make more sense than in California. So.
And this is the whole reason why you want a good financial planner, because there's so many different venues, so many different streets you can go down to find what to do.
And I was going to say before we let you go too, Harrison, when you were talking about that 9.3% at 120,000, I thought that was for a single person. I always forget how bad we get treated here in the state of California. That's for a married couple. If you make over 61,000 as a single person, you're in the 9.3% tax bracket. And even 8%, it's 48,000. And then if you're a married couple, what is that? 96?
You pulled up that chart, didn't you?
Yeah, I was like, is that 120? Wow.
And I believe the governor wants to raise it. Yeah.
No, just on the rich people.
Just not rich people. But rich is what, 120 or above?
No, I think they wanted to add another tax bracket to the upper end.
Upper end.
Yeah.
The upper end. Okay. Well, Harrison, I know it's Saturday. We're going to let you go. Thanks for the good information. And again, this is why you need a financial planner. So many different things to look at to make good decisions. Thank you.
All right. Thanks, guys. We'll see you Monday.
See you Monday. Bye-bye. All right. Again, that's Harrison Johnson. He is our financial planner. He is a CFP. He is on a salary. He doesn't sell any product. He is strictly a fee-based planner. If you want to have a conversation with Harrison, call the office at 858-546-4306. That's 858-546-4306. Or go to the website smartinvesting2000.com. That is smartinvesting2000.com. And Chase, I do want to make an announcement as well that we are moving our offices today. Because I just think if somebody calls him, I believe you send the phone tree, it is just numbers now. So you can't actually, you don't know who you're talking to. Leave a message. When you
You still call, and it's still the phone tree. So you let's say you press 6 for Harrison. You're gonna get a voicemail that says 106 is not available currently.
Okay, so it's still Harrison. They still get that way. It's just there's.
Yeah, so you still leave a voicemail, but we haven't set up our voicemail boxes yet.
Okay, that's what it is. Okay, yeah. I mean, moving's a lot, and it's just like we'll hopefully be finishing that today. All right, phone numbers here, 833-288-0973, 833-288-0973. Chase, we got to talk about it, the Reduction Act. There's a lot.
The Inflation Reduction Act.
The Inflation Reduction Act. Okay. There's a lot to the Inflation Reduction Act that I don't like, but I think the thing that bothers me most is the name of the bill. Why don't we just call it what it is? It's predominantly a climate bill and has very little to do with inflation. I will say one of the benefits in the bill is that Medicare will be able to negotiate drug prices. Far too often, I believe the government just has to pay top dollar for products and services, which makes little sense to me. The downside are plentiful, but some of the main areas of concern include how we will be paying for this bill.
Yeah, the first we talked about this briefly at the beginning of the show, but it's that 1% tax on stock buybacks. This creates value for shareholders, and shareholders already pay capital gains tax when money is made after selling an investment. This is essentially a penalty for companies rewarding shareholders, and it will be interesting to see how this impacts buyback behavior. The 15% alternative minimum tax, that's the other point that they're raising to raise funds, is far too complicated for the average person to understand, and I'll continue to monitor how this will ultimately impact businesses and their investment decisions. Most of the investments, as I mentioned, go to climate policy, with $369 billion out of the $437 billion in investments going towards energy security and climate change. Very, very broad. This includes a bunch of fluff, including something as silly as $27 billion for a national climate bank, don't know what that is, and a $3 billion cost for so-called climate justice. Now, I don't know what that is.
Right. I'm sure it's going to be some silly thing, somehow be penalized for something they're doing down the road on something, but it's just, and I don't know how many pages this bill was, but it was not, and many have come out and say this is not going to help inflation at all.
No.
And I have heard some people saying, well, what's going to happen is that because oil is so high and energy is so high, if they invest into clean energy like solar panels and EVs, down the road they'll have less inflation. Well,
how long down the road? Because I believe there's like a $17 billion tax on oil. There's a $6 billion tax on natural gas.
Yeah.
So, let's raise taxes on the areas that are already hurting people and raising the cost of everything else. I think this could hurt inflation.
Right.
And the thing that is interesting, too, I know we got callers here, but is the fact that people just act like companies aren't going to change their buyback behavior. As we already talked about, companies are looking at accelerating buybacks this year to avoid the tax. So, you're not going to get those funds. The alternative minimum tax, if you look at accelerated depreciation, if they get rid of that, what happens then is companies may delay investing in projects, say, okay, well, if I take accelerated depreciation this year on this project, and if I did another project and took accelerated depreciation, that's going to push me down to 12%. I'm going to have to pay a 15% minimum. I'll just hold off on this project till next year. There's going to change the way businesses plan their investments.
And I've often said I wish more people in Congress and the Senate had more business degrees, more understanding of business, because they think they're being smart doing this. But you have CEOs that many times graduates, MBAs from Harvard and Princeton and Yale. I mean, these guys will find a way around it. And unfortunately, the people in the Senate and Congress, they don't understand business very well.
And it's not even the CEOs. You have teams of people that have had these extensive research of accounting, and they can find loopholes, and they're on average going to be way smarter than the politicians.
Which is true, and I hate to say it. So I just wish that the politicians would requirement. You want to be in office, you got to have a degree in economics or finance or something, so you at least have some understanding of the concepts of what's going on. All right, enough said about that. Let's go up to, we're going to go out to San Diego and speak with Anthony. Anthony, you're on the Smart Investor Show with Brent Chase. How can we help you?
Hey, guys. Another great segment today. Just a shout out real quickly to Harrison. I happen to be about to draw on my retirement, so I just loved hearing his take on, what to expect in terms of, retirement income. as well as holding on to real estate. So I'm going to knock on wood, which means I'm jinxing myself, but I do have a rental property.
Well, what you should do is
positive
not
cash flow.
What you should do is not knock on wood, but knock on his door for a conversation with him directly.
No, I'm one of the lucky. I had existing property. I did better in the pandemic. I refinanced both my home and my rental home, and so my expenses went down. My positive cash flow on the rental went up.
Good.
It's and a ton of equity in it just with the bump up. But hey guys, the reason I'm calling, I have a little bit of cash that I was thinking of in putting into one of two stocks, LDOS and QLYS, and they're both in a sense of cybersecurity. One's a little bit more into defense, right, with the things that have been going on and with Russia and their continuing attacks on our system, as well as on the private side, people that get kind of hijacked that way, or their systems.
Okay. Well, let me take it, because Lidos came up first, and I got some people behind you, so I'm going to try to get at least another person behind you here. Yes. So let's talk about Lidos Holdings, or symbols LDOS. They are in the Information Technology Services, only 0.9% float, 82% institutional ownership. Not a bad PE ratio here at all. 20, that's half the industry at 42.6, so that's a great start. Yeah. Price to sales, 1 versus 2. Price to book value, 3.5 versus 3.6. Price to cash flow, 15.9 versus 16.9. And a good PEG ratio, 2.4 versus 5.8. So the valuation ratio is looking pretty darn good here. As far as the growth goes, earnings per share were only up 0.4% over the last year. That pales in comparison to the industry, up 19.7. Sales for Lidos are up 6.1, about half the industry at 12.4. They do pay a dividend of 1.4%, only use 27% of their earnings to pay that out. Looking at the balance sheet here, current ratio 0.9 versus 1.5, that's okay. Debt to equity is on the high side, 1.5 versus 0.9. So that's I don't like to see much above 1.2, 1.3. Could be some reasons for it, but again, you're well above the industry, so I'm not happy to see that. Net profit margin 5.2 versus 5, and return on equity 18.1 versus 19. So far I'm not too happy. I like the valuation ratios, but we seem to be missing something. It's up to you, Chase. What do you think?
Yeah, well, it is an interesting company, because I know they do the airport scanners too. So
they do?
Yeah, I believe that's the case. And I Googled it. There's the Lidos airport scanner. So I'm pretty sure it's the same company.
And we came back from Fiji, went through L.A., and the airport scanners were not working very good at all. Not just for us, but for about 10 other people. I'm just saying that maybe there's some issues.
Hey, or maybe it's good because they got to replace them.
Well, there you go. That's the other side of the coin.
You're pushing me to QLYS.
But let's take a look here, too, at the numbers going forward. And the current price to start off with Lidos, again, ticker symbol LDOS, is $102.58. See, 52-week high here, $111.12, and the 52-week low, well, that's $81.07. They have been a benefactor this year, and it could be perhaps because of the Russia-Ukraine tensions and increase in defense, potentially spending, as the year-to-date return up 16.2%, as we know that the market has struggled overall. But if we go forward to December 2023, I do see estimated earnings per share of $7.07. It would give us a target sell price of $117.36. So that is above the current level of $102.58, but it doesn't really give us a nice margin of safety. Most of the time we like about a 30% differential between the sell price and the current price before we step in and buy. So it would be placed in what we call our hold category.
Yeah, I see they have reported earnings already, so that's out already. So you'd either want to pull back on the stock or for those numbers to be increased, but you'd have quite a bit. So not a time to buy at this time. Just kind of watch it and see what you got. Maybe next week call back on the other company, because I do want to try to get the last gentleman in for the show here.
Oh, yeah, you got it. No problem.
Thanks for calling in, Anthony.
Hey, another great show. Thanks, guys.
Thank you very much. Talk to you soon. Bye-bye. All right, let's go out to Lakewood and speak with Johnny. Johnny, you're in the Smart Invest Show, Brent Chase. How can we help you?
Looking at LKQ, they took over Pick Your Part.
Pick Your Part. I've never heard of Pick Your Part. What is that? Have you ever heard of that, Chase?
No.
What is Pick Your Part?
It's a auto dismantler, and they not only sell the parts at the junkyard, but then they get the scrap metal value later on.
Ooh, I like that. See, that's another business I like. It's one that, the junkyard and stuff like that, where it's good value there. So I'm hoping this works out pretty good. Company is LKQ. That's the same as their symbol, LKQ. They are in the auto parts industry, only 2% short here on the company. 100% institutional ownership, so that usually kind of messes up with a short on there and so forth. But we'll move on from there. We do see a PE ratio of 13.4 versus 22.4. That's a positive. Price of sales, not a positive. 1.2 versus 0.6. Price of book value, 24.4 versus 8.8. That is price of tangible book value. Price of cash flow, 13.8 versus 13.1. A very good PEG ratio, though. 0.4 versus 13. So the valuation ratios were not that great. But what you're paying for the earnings going forward does look pretty good. We do see the last year earnings were up 34.6%. This is while the industry was down 30.3%. Sales did climb by 4.5%. Industry was down 0.7%. They do pay, I'll call it a decent dividend of 1.8% and only use 18% of the earnings to pay that out. We do see a current ratio of 1.7 versus 2.6. I'm okay with that. Debt to equity 0.7 versus 0.6. That is okay as well. We do see a net profit margin of 9.2, about 3 times the industry at 3%. And return on equity 21.7. That's very good. We like equity above, or return on equity above 15%. Industry is only 6.7. So Chase, what do you got going forward?
Yeah, so current price here for LKQ, $56.07. 52-week high, well, it's $60.43. And 52-week low is $42.36. Year-to-date down about 5%, so we've seen a little bit of pullback on the stock, but nothing too crazy. Now we go to December 2023. I do see estimated earnings per share of $4.27. Would give us a target sell price of $70.88. It's about 26% away from its current price. Again, we like that 30%. So I'd keep my eye on it. I wouldn't be a buyer necessarily yet at this level, but it doesn't take a whole lot in terms of a pullback to give us that 30% margin of safety. And as I said, I like the business, the fundamentals overall in terms of the balance sheet and what the company does. Obviously, sounds pretty good. Yeah,
and it gets to fall to 54, 55. There's your buy. But again, a lot more research on this one here because there's some things that, again, the valuation ratios I wasn't that excited about. I would do a lot more research on it. I like the concept again. I like, the junkyards and stuff like that because usually their profit margins are pretty good, which I think on this one it was. But do some more research there, Johnny, and it could be a good one at the right price around maybe we'll call it 54, 55 maybe. All righty?
All right. Thank you for your time, sir.
All right, Johnny. Thanks for calling. Have a good one. Bye-bye. All right. I was going to say that it opens the phone line, but we only got about 2 minutes left here of the show. I think we got through all the callers. I like doing that. I always feel guilty leaving people at the end. Not that you shouldn't call at the end because we'll try to get you in all the time, but it's just I like to go through and have the conversation with the people and really try to get their questions answered.
Yeah, no, absolutely. So I'm glad we were able to squeeze in those last 2 callers there at the end, and it's important to us. I know what you're talking about because at the end of some shows, it's like we have like 3 people that all called in at the end. And you're like, oh,
yeah.
And they never call back in the next week.
I know. And we would say call back in next week if you miss us there. And also, too, if you do miss a show, it is podcast. You can actually see that on our website. Go to our website, smartinvesting2000.com. Again, that is smartinvesting2000.com. You'll see the podcast. Click on that. You can listen by Spotify, Pandora, many different ways to listen to the show. If you missed the show, missed part of it, want to rehear something like, what did they say on that? I know sometimes you and I are both accused of talking sometimes too quickly. We get too excited about this. I mean, this is so, it's so funny. I've been doing this show for over 30 years. Last night I was saying, like, I can't wait to get up tomorrow morning and go do the radio show. I mean, after 30 years, I still love doing it.
I was excited too, but I was tired, so.
Yeah, because you had a football, well, and you're back to the football games. How did Poway High do last night?
Hey, yeah, JV won 28-0, so I was pretty happy with that as a defense coordinator. Nice goose egg, and then varsity won, I think it was 31-19 was the final score, and very, very good opponent in Granite Hills. So,
wow,
we're really excited about this year and the team that we have at both levels, and programs doing well at Poway High.
Oh, cool. And actually last week I was at the car show for the Corvette Club benefiting the San Diego Blind. That went very well. Gave out a trophy for a gentleman, actually he's a listener. He has a 2012 Boss 302. And I said that should appreciate the most over the next 10 years. All right. Well, there's the closing bell. Thank you for listening to the Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs or have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-546-4306. That's 858-546-4306. And visit our website. A lot of great information there. smartinvesting2000.com. That's smartinvesting2000.com. And for more daily educational information along with investment tips, go to our Facebook page, Smart Investing with Brent Chase Wilsey. Have a great day. We'll talk more next week right here on the Smart Investing Show.